If you want to ride the stock market boom, then Stallion Asset is your jockey.
The Unlimited Abundant Show. Frameworks to being limitless in wealth, health, work, and life with your host, VB.
In just 15 weeks, develop your own wealth generation toolbox for an abundant life. This course is powered by Vineet Boninchkar's 12-dimension investment toolbox, a precise stock picking methodology that takes your investment strategy for building unlimited wealth to the next level.
Hello everyone and welcome to the maiden show of Unlimited Abundance, Frameworks to Successful Life. And in our first show with us we have Amit Jeswani of Stallion Asset Management. And Amit is a star in his own right. I've known him for about a little less than a year now, and in our interactions I've developed great respect for him. So Amit, why don't you let all our folks know a little bit about yourself, where you started from, what's happening with you, and how your business has grown.
So we started, thank you Vineet for having me on your show, and congratulations on your new show. We started first in 2004 and my father was a stockbroker, so that's how the whole story started. I was the guy who was always in the market when all my friends were going out and playing. I was always there and understanding the stock market. So I started really early in the stock market. That was phase one.
So you're a really boring guy.
Yeah, very boring guy. so that was the first start of the stock market. The second was when I was in the UK. So I was studying in Kingston University in London. And that's where I got a chance to work with one of the largest investment banks there on the trading desk as an intern. And the best part was that I didn't have to serve coffee. So that was like the good part. So that was my first interaction with real big time stock trading. And let me tell you one thing. I went bankrupt 5 times between 2004 to 2009 every year with small sums of equity like 1, 2, 3 lakhs. I used to lose it all by leveraging, taking options, futures. So I've done all that from the start. So I lost, like, broadly I went bankrupt once every year, and that was like for sure. But so in 2009 was my first, 2009-10 there was a big program by one of the largest investment banks, and I got a job there in London. So that was my first large interaction, and when I saw traders there making 100 million, 200 million. So what fascinated me was that traders were the guys who, you know, had the best cars, so wealth. They were drinking the best wines and whiskies, and they always had the right woman around them. So whiskey, wine, woman. So wealth, woman, whiskey. So that thing attracted me initially, and since then I came to India in 2010. I started working with one more bank as a trader, then with one brokerage house as a trader. So I was always on the trading side. I was not even there on the investing side till 2012. I was doing my CFA, so I used to wake up really early and because I was then working for a hedge fund as well. So I was always there in the markets, but more on the trading side. Then 2012 was basically the game changer, where we got more on the fundamental side, and I was doing my CFA, and then I did my CMT and became a double charter. 2013 we started this, and we've done okay, so our returns are good enough. So we've given 663% returns to our clients in the last 5 years. So we never focused on...
Again, 663% return.
In the last 5 years. So that's broadly about 50% CAGR.
That's impressive. And having gone bankrupt 5 times to giving 663% returns, I'm going to really well.
So, yes, so we were lucky. We were partially lucky, and partially the timing was good. But we do expect that smart investors in India will always make 30-40% plus. And it's not so difficult making 30-40% in India. I don't think so it's difficult at all. Yes, so that was my journey. Today we're the second largest advisory company in the country. And we manage somewhere around 400 crores. We're coming with a PMS, so that's very small sums that we're managing right now. We're coming with a PMS in the next 4 months. I'm very excited for it.
Okay. So now, going from going bust so many times, watching the traders make a lot of money, okay, being on the trading side and then moving towards investments. So you've done the whole circuit. So tell us about your journey, your learnings from trading, okay, admiration for all these traders, and then finally settling onto this stage where you have kind of turned an investor, and that too a successful one.
So I'll be very honest with you. I am a guy who read and I fancied traders. So Paul Tudor Jones, Jesse Livermore. If you see our style of investing, it is still catching those long-term trends. So we are investors, but we work like, we do have those trading styles that we still incorporate. If you see my largest loser is not more than 25%. So we are very, very, very patient with our winners, but we are very impatient with our losers. This is a style which I have learned from the trading desk, that how to be patient with your winners. And if a person can learn this, you can learn a lot. So like how a trader looks at patterns, an investor also has to look at patterns. See, we learn from all successful investors globally. And if a person can read about 20 successful investors, be it Warren Buffett, what is his investing philosophy? He bets on moats, right? Yeah. If you look, so every investor is basically not betting on the market. He's betting on a pattern, and everyone has a different pattern. Ed Sekiota is betting on trends. So Paul Tudor Jones is looking at reversal trends. So every investor is different, but you need to look at your pattern. The pattern that we like is growth investing. We will never ever buy companies which are growing at 10-15%. We want companies that grow at 30-40%, because that's where real wealth will be created. Growth in financial market is rare, and once you get them right at a reasonable price, you get rewarded enormously well. So we are very growth investors as our style of investing. Now, how did this growth investing come? Again, so we don't know the future so well, but we know our past really well. We went back in history, so from 1994, since NSE started, till 2017, we did a research. What are the biggest wealth creators in any 3-year period? So from 1994 to 1997, what are the big wealth creators? Then from 1995 to 1998, which are the big wealth creators? We found commonalities, and these commonalities were exactly the same. So example, from 1996 to 2000, that 4-year period, you had your IT stocks going up 350 to 400 times, so but during that phase, you had your entire IT companies growing at 100%. So your Infosys grew profits from 13 crores to 285 crores in that 4-year period. Wipro increased its profit 15 times in that 4-year period. So first you look at changes, because change is the first side of disruption. And then internet was a change, and that created your your IT bubble. Then the big change was, then you had small changes, like change from bikes to from scooters to bikes, and you had your Hero Honda, which created a lot of wealth. Then your changes were changed from wireless, from wireline to wireless, and that's where your Bharti and all those other stocks created large sums of wealth. Bharti went up 60x in that 3-year period. So, and Bharti was again growing at 100-200%. So what we are looking at, look out for the change, and then once you get to that change, bet big on that change. You don't need a very diversified portfolio or being in all sectors. You need sectors which are like an emerging story, and that's where big wealth will be created. Like 2009 to 2014, again you had your consumer companies, you had your pharma companies that created enormous amount of wealth, and trends are very strong. It's not very difficult catching trends. If you see your Nifty earnings growth between 2009 to 2014, that was around 5-6%. Pharma companies were growing at 30-40%. So it was just not, Sun Pharma was growing at 30%, Lupin was growing at 30-40%, Aurobindo was growing at 50%. So when the whole pack grows together at 40-50%, that's when trends are created. It should not be just one stock, because that won't be a very strong trend. The whole sector should move in exactly the same way, and that is what we do. So we catch first the sector, that this is the sector where there's a change which has happened, the tailwinds are strong, and then you keep betting on it. Like, I'll just give you an example. Our portfolio was broadly, after 2015, 40-50% of our portfolio has been NBFCs. So private sector banks and NBFCs, that's been our portfolio 40-50%. Here again the story was simple. Since 2014, the banking system can be divided into two parts. 80% market share is with your public sector banks and 25% market share is with your private sector banks. India's credit growth is broadly 10%, right? So you had your since these guys started recognizing NPS, your public sector banks, so these guys could not grow, the public sector banks. So you had value mitigation happening from your public sector bank to your NBFCs, and NBFCs were growing at 30-40%. It's not that this is insider information. Everyone knew it, that PSUs won't be able to lend and these guys will keep growing. And that's how we've been looking at value mitigation. Where is that big change which is happening? And change creates wealth. So we look at changes very carefully. So that's broadly our investing style. Yes.
So you've spoken very strongly, and I can feel it in your body language also. You're very, very focused on these trends. Can you guide our viewers onto how do you go about spotting a trend? Like, can you actually walk through a framework for tracking trends, identifying a trend, eliminating stocks, and then zeroing on the stocks?
So see, when you see the first few quarters of earnings growth, okay, most people get it wrong if you cannot know if this growth is sustainable or not. So the real question is this growth sustainable? Because everyone knows after 2 quarters, a small screener or anything would tell you that this growth is there. But what after that? Is this growth sustainable? So we meet a lot of management. I was telling you we met 120 managements in the last 6 months. So
120 managements in the last 6 months.
So we meet.
So this guy is really, on his toes, if I may say.
So we meet a lot of people understanding that. See, once we identify the trend, we just have to know when will this end. And I'll come to the ending trends part since we are still at the beginning of it. So trends begin with a change. So first thing is how big is the change. Internet was a big change. So the delta was 300x, right? A change in steel price is not such a big change. Like, it's a change, but it's not as big. So the rise will be, let's say, 2x or 3x. So the NBFC change was a very large change because you had 80% sector which was dead and 20% sector which would grow at 30-40%. So there are two types of trends. Trends which last for 2-3 quarters. Now those don't get sucked into it because you'll lose a lot of money. There are the second kind of trends which last for the next 3-4 years. And you need to know what will make that 3-4 years sustainable. The first thing is operating leverage. If let's say the capacity is 40-50% and the company starts growing, or let's say the sector starts growing, then you see that this change can last for a very long time. I'll just give you an example. Equipment finance, equipment was a sector, construction equipment.
Yeah.
So I don't have any positions there, but since I don't have a position, I can tell you about it. This sector was 2,000 crores. The total market size of equipment in India, construction equipment, was 2,000 crores in the year 2000. In 2011, this construction equipment business became 31,000 crores. So a 15x jump. But last 5-7 years, there has been there's no addition to construction, and these companies were trading at 30, 40, 50% capacity utilization. So once you see that these stocks, since infra is a very strong uptail right now, so once you see a small takeoff, you start seeing what will happen now. So construction, let's say now the construction equipment industry as a whole last year was about 25,000 crores. So it fell from 31,000 crores to 21,000 crores. The capacity utilization of most construction manufacturing companies, equipment manufacturing companies, is about 40-50%. Now if the boom happens, you will see huge increases in margin because there is operating leverage, and huge increase in financial leverage, like your financial leverage, because debts will come down, all the cash flows.
Yeah.
So that is one way of getting in that this is a trend which is sustainable or not. And then you see what is happening, how big the tailwinds are, you speak to people, you see what infrastructure companies are doing. If I want to know about construction equipment, I also need to know what is happening. And after 5, 6, 7 years of bad runs, normally no new player comes in the market. Okay, because you have the guys who are incumbent, they themselves are not able to make money. Why would you come in the market? So normally new players come when there is a lot of hype and not when there is a lot of pain. So that story works for us. We normally bet on industry when 70-80% players are injured and 20% players are able to take on the market share. Example, infrastructure, which is, this is no recommendation, but I'm just giving you. In the last 7-8 years, because of bot or whatever be the reason, 70-80% of infrastructure players are now out of business. They don't have the balance sheet strength to bid the next project, and I guarantee you they cannot execute the next few projects. You have the high quality 20% of the infrastructure companies that will keep taking on market share from these guys. Now, there's a big tailwind, which is your Bharatmala project, right? So you have 3 lakh crores worth of orders which are coming in the next 1 year, and you have only 20% market who can bid it. The total market cap of this 20% the 20% basket is about 25,000 crores. Now, these become like no-brainers for us. So once we bet big, and then stay till the cycle moves higher. So that is what we do.
Okay, so you have shown this juicy pot to everyone. The pot of gold at the end of the rainbow that you have shown very nicely as far as sectors are concerned. So how are you now zeroing down on the stocks? What are the stocks that you would pick up? What are the factors that you would look at?
So the first factor is how big is the opportunity size. Once that is determined, then we go down deep. We normally 70 to 80% times we meet the management and understand, is he going to be the one who is ready to scale it up? Because some managements are lazy as well. Because once you are making 30-40 crores a year, you don't want to like venture out and go and make 100-200 crores. So that just intention itself tells you that will this guy be the one who will be the fastest growing one. That is number 2. The third is the quality of management. We do pay a lot of attention to the quality of management. But what my learning has been that when growth is strong, markets will ignore quality of management. We personally, because we are investing a lot of money, and for us there is no exit if we go wrong. So we take a lot of care on the quality of management.
So this growth hunger, where we talk of management leadership, growth hunger, and the promoters, quality of promoters, the business and the financials. So there are 3 parts to it. One is the business, one is the people running the business, owners of the business, and third is the financials. How much weightage would you assign to different aspects?
See, so whenever we buy a stock, there are 3-4 kinds of risks that we are taking. One is business risk. The second is, as you rightly said, the financial risk depends on the leverage they have. The third is the valuation risk. At a price, everything is good. At a price, everything is bad, right? At the start of the cycle, see, identifying a sector trend has to be at the start of the cycle, because if you are going to identify it too late, then your alpha disappears. The idea is to create alpha. We're not in the business of creating 15% CAGR return. It's not bad, 15-20% is good returns. But we are ready to put in 80-90 hours a week, whereas our peers are putting in 40 hours. So we have an edge to work harder because we are younger, to go and see everything, that what can go right and what can go wrong. Coming to the management part, it is very, very, very difficult figuring out which management is good, which management is bad. Prior track record is the only way you can see it, and use bet on intentions. But it is not possible for 99% of investors, even though they claim that they are looking at management quality and everything. But see, the P ratio decides it. At 6P, everyone will call every management a chore. At 30P, people will call the same company a moat, right? So the money is made when people call it chore, but it ends up becoming a moat. So that's how markets are. So let's say if a company is at, let's say, 7P multiple, if it grows at 20, 30, 40% for next 2-3 years, believe me, the P ratio will change to, the earnings will multiply and your P ratio will change. So also depends on your return on capital employed. But so earning multiples changes with growth. So at 6P, I guarantee you, when everything is cheap, they will all call it a chore. At 30-40P, they'll come with such, like, this is the outsider, this is the best company ever, but it's already there in the price, and then if you buy it, you're not going to make a lot of money.
Yeah, so then what are the red flags that there's another way of doing it, is like, I look at elimination criteria.
Right.
So, what are the red flags that are no-nos for, avoiding certain management?
See, the first thing that I check is operating cash flows. If there is no operating cash flows, I am not going to be in debt. So we did a study on debt. That is the second thing. First is operating cash flows. Second is debt. Debt. So 63% of BSE 500 companies in the last 10 years. I repeat, 63% of BSE 500 companies in the last 10 years who had a debt to equity of more than 2 have at least gone bankrupt once. So the thing is, avoid debt. But in some businesses, so it again depends business to business. So in some businesses, thoda you can give out a leverage that debt is okay. Let's say the power grid. If I attach 2 times debt to equity, you don't have to be worried because that increases the ROE of, because this business is so stable that it helps as a leverage. But in majority of businesses, debt is a very killer thing. Then the third thing we look at is return on capital employed. If the return on capital employed is like for the whole industry is not high, that doesn't impress us at all. So we like businesses which are asset light, business that are very scalable, and because you need growth and you want to invest less money for that growth and not keep on investing money for that.
Do you have any kind of a benchmark ROC or an ROE that you look at?
Anything more than 20% is good. So we rarely get into companies, except for the financial space, we don't have any investments in companies which have less than 20% ROC. ROC is very important. ROE is very important in financials as well, because let's say your book value is growing at, many banks have a ROE of 10-12%. So there, if you buy, let's say, at 2 times price to book, right? Every year the book value will keep growing at 12%. Even if the book value moves up, let's say, to 2.5 or 3, you don't make a multi-bagger return. You make very ordinary 17, 18, 19% kind of returns, which is not something which we like. So ROC is very important. So if you take the top 100 companies with high ROC, it should not be cyclical companies in ROC, because cyclical companies can have 2-3 good quarters and then your ROC should be there. I'm speaking about non-cyclical companies because we rarely invest into cyclical businesses. So cyclical business for us, for our core portfolio, is just a no. And yeah.
So when you talk of, you spoke about 6 PE stocks, but when the trend is turning, then the ROC is not there.
Right.
Okay, so then the ROC might be, say, 10.5. The best companies might have 15%. So how does your cutoff criteria work for you?
See, it all depends on the phase of the bull market. In the first phase of bull market, so I determine the bull market in 3 phases. The first phase of the bull market is the phase where screeners will work. So if you look at screeners, you will make a lot of money. You just put high growth, low P multiple, high ROE, and everything will be at 10-15 P multiple, all good stocks, and you make a lot of money. That's like the most easiest way of making money. Majority of investors, including myself, have used that method and made a lot of money. That is easy way. The phase 2 of the bull market, which we probably have missed or is over, was the balance sheet way, where balance sheets are strong and some small kick in profits will give out a very large delta to, like a small change in business cycle will help you make a lot of money. So that is the second wave of the thing. Now is the third wave of, the next wave of the bull market will be information, and the people with information will make a lot of money. So this is like the very most difficult way of, the third wave of the bull market. Your information is very, very important. So you need to have not insider information, so the prices will get reflected very soon. Example, molasses prices went down 60%, 70%, right? Molasses is the key raw material of alcohol companies. So the prices of Radico went up through 3-4x. So that's where real wealth was created. But it didn't come to the financial statement. It only, till the time it was there on the financial statement, you could have not, like, it was too late, right? You would be buying Radico at, let's say, 345, 400. So the stock was already a 4-bagger. So now, since you are in a very strong bull market, information will create wealth. And let the steel cycle, we played the steel cycle really well. So those kind of things, HEG, rain. So till the time it comes to the financials, you're just too late. So you need, Jeff Bezos said one thing, that you need to bet when you have 70% of all the information that you need available. Because if you wait till 90%, you will be very late in the market, and that is the phase that we are in right now. So this is like the third phase where the markets are super efficient, and that's how every bull market cycle has been till now, and it will be always the same.
Interesting. So having said all these things, can you take us through all the stocks? So we've seen the positive side where you made a lot of money. You know, any dud stocks you have, and how do you deal with them?
See, I have lost a lot of money in, so we got the airline trend well, but we didn't hold it because even after the results coming good for 2-3 quarters, the stocks were not performing. So we've made a lot of mistakes on, we've rarely made mistakes on catching trends, we've made mistakes on holding on to trends. We missed out and missing out on trends. So we missed out the sugar cycle even though we knew it, but it's a commodity, so we didn't play it. So we've made more mistakes that side. See, as a rule, if a stock is not doing what you expect it to do, get out of it. If after buying my stocks don't perform well for the next 2 quarters, I normally say that, okay, somewhere I am wrong. It is okay in the market to lose 20%. No big deal, you get it back. But I normally say that markets are right and I'm wrong, so I lose 10-15% and get out of the story. I cannot stay with my, so as a rule, I just cannot stay with my losers for a long time. Probably I've come out from a trader background, and that's the way we've learned to manage. See, there are 3 ways of managing this. Way number 1 is the Warren Buffett way, where you buy good moats, and there is good high quality moats. The way number 2 is that you buy companies at such bad valuations that like nothing can at cash value, and that becomes your margin of safety. The third is price action. So we don't believe that price action is the right margin of safety, but if 2-3 quarters my stocks don't do what I want them to do, I say somewhere I went wrong and let's just move on to the next idea. So that's been my losses. We lost a lot of money in Talna Solutions. So that again was a good story. We knew the management was dodgy. We lost I think 30% or something. So that was our highest loss. So this company was into OTP. So SMS, OTP SMSs. And this company had 70% market share. This company had fixed assets worth 600 crores, okay, and we knew there is no thing as fixed assets worth 600 crores because they were not depreciating it. But we said the trend is good because OTPs were, so if you go to an Uber, you need an OTP. If you use your credit card, you need an OTP. If you use Paytm, you need an OTP. For everything that you do now, you need an OTP. So this guy had 90% share in sending SMSs to you. So all the SMSs that you get is via them. We tried meeting the management. We knew the management was dodgy, but we thought we were smarter because the management themselves were buying at 40 per share. So they issued warrants at 40 per share, and we ended up buying a very large stake there. We thought management हमारे साथ है, डर की क्या बात है? But that didn't turn out as we expected, and it was very difficult actually selling out that stock because we were basically selling it on lower circuit because they were not showing good numbers. And see, there's no longevity of business. We knew that this business will not, see, technology changes. You went from VCR to CDs, and CDs were Moser Bear was bought, and from Moser Bear came pen drives, so some other company. So we knew OTP will be replaced someday, but like tab tak to bhav upar chale jayega. So that is one place where we horribly went wrong. We knew the management was bad. We knew they had dodgy accounting. But we were like, trend अच्छा है तो एक बार खेल लो. That is like digital. So that time we were actually long many digital companies. So we were long Kenton Tech. We made 4-5x there. We lost money in Talna. There was 1-2 smaller bets also that we taken. So that time, actually this all started from the e-commerce. So e-commerce was changed. I'm speaking about 2014. Yeah. So the big change there was e-commerce companies coming in. So we went long all logistic companies. So we went long Gati, TCI, 1-2 more logistic companies. So these companies had a bankrupt business model. Gati and all these companies had no business model left anymore because via emails the whole business model was disrupted. And with e-commerce coming in, that was a big change, and these guys started showing growth, and you had your blue dart which was growing at 100% quarter over quarter. on the e-commerce side. So we said, boss, this is change and let's go. So we made a lot of money in Gati and Patel Logistics. Even though Patel Logistics had no thing to do with like the delivery of this thing, but it signed one pack with Amazon. So you know, we look at changes, and once we get change, we sometimes go right, sometimes go wrong, but change is important. Look at change, and if that change puts out accelerated earnings growth for the next few quarters, just go and buy it. So that's what we do. And then if you go wrong, you lose 10-20%. If you make 4, 5, 7 times. But now we have to be more responsible because we're putting in like a lot of money than what we were in 2014.
So, you know, having seen your investment philosophy and the way you approach the markets, let's look at brass tacks. So when I say brass tacks, I'm saying how do you go abroad, how is your day spent? Tracking stocks, tracking these trends. What are you doing to connect with 120 managements?
Right.
You know,
so
how are you networking?
So I personally have never even spoken to a management before my meeting is set to him, because we have our people who do it, and we have a team who does it for us. Okay. So I personally don't ever speak to even an IR guy, or I just go to meet the management. That is thing number one. So how does my day start? Well, my day starts at 6:30 in the morning. That's when I wake up. At 8 in the morning, I'm in office. I'm seeing what happened last night in reading newspapers. I read 3 newspapers every day, and then the Wall Street Journal. So I keep a track of global markets very well. I come from a global background because I was working in a global asset management company. So we were sometimes trading US, sometimes we were trading Germany, sometimes Japan. So I understand how the global markets, how an FI thinks. So I understand what's happening. Trends are global. So I'll just give you an example. Pharma topped out in India in 2015. It topped out in India in US also in 2015. China also topped out in 2015. The IT trend, which the FANG stock trends that we are seeing in the US market, the trends are same in the Chinese market as well. Tencent is up 450%. Alibaba is up 4x in the last 2-3 years. So trends are global. So I do read a lot of things which are happening around the globe. So that's my morning. Then I do look at stock prices every 30 minutes. I have to do that. So I'm not a guy who says that I forget my stocks. Never ever. I need to know. I don't do anything, but I do have to look at my stocks once and every 30 minutes.
So you don't get an impulse to see the stock and make a trade?
So we don't have a board. I use Google Finance for it. So we don't have that red blue thing. That's a killer thing. And so that's my day. And then we have con calls, and so every team member is coming with me with an idea. So we normally speak about the idea, why this is good, why this is bad. They're coming with management meets. So they keep telling me what's happening in this industry, that industry. So my job is just to connect the dots. So if a builder says that I'm increasing, Bangalore-based builder says that I'm increasing my buildings by 10x, and same guy from that location, because cement can't be transported, saying that I'm seeing demand. Visibility of demand. So you know, you connect the dots. So that's how my day goes. 5 o'clock onwards, I'm looking at information which is legit, and we're looking at who bought which shares, which companies did warrants, and the announcements and all that. So we are always knowing what is happening around us. We have a query desk, and I do reply on the query desk. So that's the time that we spend. So I'm in the office till like broadly 11 in the night. So I eat my dinner in office, I eat my breakfast in office, I eat my lunch in office. So we work harder than our peers. And yeah, so that's how my day goes. And it's always in office. We work 7 days a week. Even if you call me at 9 in the morning on a Sunday, you'll probably find me here.
So when you're in this lovely pad, practically 24/7,
yeah,
do you breathe? And
see, this is breathing. So we've got golf in our office, we've got a PlayStation in office. So our office is a cool office. So we have everything that a guy might need in office itself. We also have a sofa. So if I want to sleep, I can sleep here. But that rarely happens. See, the market, you need energy. If you don't have energy, and if you're not passionate, then 95% people there, you will not make money. And this is not from 1 year I'm doing this, it's from because I was doing my CFA and my CMT with my job. So I was working literally 14-15 hours, not from now, but from the last 5-7 years. So it's become like a habit, and I cannot stay home. And I'm not even interested in cricket and all. So if my friends want to come over, they come here. But I go out partying on Saturdays. But it's mostly the market.
Yes, so your party is also investment me.
So on the mornings, yes, I meet you. But in the evenings, I do go out partying and know what's happening in the world beyond markets, because that's very important, you know. And not little bit politics I'm interested in, so I learn. So in fact, we have just got in one of my friend who's now joining us. He's the head of strategy at Hotstar, and he would be taking RPMS forward, and we've just got him here at Stallion. He joins in the next 1 month, and he was the guy who was doing the campaign for Amit Shah in UP in 2014. So he designed the campaign. So me and him are like good friends, and now he's a part of Stallion. So we're an exciting team. Everyone here is a CFA, and everyone shares a lot of knowledge. So we share a lot with each other. We stay like family. So that helps, and it's passion, you know. It is all about how much you're willing to give to this market.
Okay, so having seen the energy, the passion, your trends approach, and we've seen how you go about your day. Now comes to the crux of the matter, is how do you allocate how many stocks you have in your portfolio, what are the sectoral allocations, and there is this big debate around having a concentrated portfolio and diversified portfolio. So how do you know, is there a mathematical model you follow to fine tune this?
There's no mathematics, to be honest, which goes inside it. The allocation, so there are two ways I look at it. We never had more than 15 stocks in our portfolio ever. So the maximum we've got to is 15 stocks. Pre-2015, we used to have 7-8 stocks in the portfolio. See, if you know what you're doing, risk is not knowing what you're doing. If you know what you're doing, then you don't have to worry. You're chasing a pattern, the pattern which has a very high probability of working. And if you're wrong, you lose some money, right? So once you know what you're doing, you don't have to worry about having 30-40 stocks in the portfolio. If you don't know what you're doing, that is when you need to have 30-40 stocks. If you have low conviction, low confidence on your ability to do stock picking, then you need. I personally don't even have so many ideas, to be honest. I rarely get 10 ideas a year, so that's how bad I am with coming up with new ideas. So we have 10 ideas broadly a year, 6-7 work, 3-4 fail, and that's okay. But we never had a diversified portfolio. See, you're in the business of making money. If you know you're right, why bet on the 20th best idea when you can put more money on the first or the second best idea? In fact, I average my winners on the way higher. So if a company, if let's say a management comes up with a good numbers or better than what I initially expected, I add more weight to that stock. And if the stock is not the initial story is good, but the company not coming with good quarterly numbers, I cut down weight there. So I keep swapping wherever my numbers are coming better. I keep adding, and it has to be backed by price action, of course.
So you're very dynamically adjusting your portfolio.
Absolutely. For my personal portfolio, yes. For our see, buy and hold also has momentum inbuilt in it.
Yeah.
Right. So if your better performing stocks, the weights are automatically moving higher. Your bad performing stocks, your weight are automatically moving lower. So in that context, we do look at it, but we've never had, I think we have 12 stocks in the portfolio right now. We'll never have more than 12, 13, 14.
So between those 12 stocks, what is the highest allocation? Your biggest conviction, how much is it?
So my personal portfolio, my biggest weight is 24% in one stock. On the client portfolio that we have, the top 5 holdings are broadly 60%.
So you're saying 10
in sectors, total the whole portfolio is divided into 3 sectors. So the whole portfolio is into 3 sectors, and then within that 3 sectors there are 12 stocks. So broadly 3-4 stocks.
So you don't go beyond 3 trends.
There are not so many trends which are there at the market at any given point of time. So wherever, see, between 2009 to 2014, if you think about it, the trends were pharma, consumer, and FMCG. So you had your FMCG stocks like Godrej Consumer and all those guys growing at 25% plus. You had, so those were inflation hedges, because that time the inflation was 10% and these guys had pricing power. You had Lao, Pala, Kajaria, everything to do with home that was doing well. And on the third side, the third was the pharma stocks that again were growing at 30-40%. So those were the only 3 sectors that were growing at 30-40% when the whole index was growing at 6%. So wherever we have growth, we go there. So at no point of time we ever find 3-4 sectors. So it's not that I want to have 3 sectors, but I just want to be where the big delta is.
And how do you maintain risk?
Risk is, see, we need to get it right. So growth investing over long term will not beat value investing. But if you buy growth companies at a reasonable price, you will beat both growth and value together. So we make sure that all our investments are growth at a reasonable price. So we will never overpay for growth. So we didn't go out and buy a DMart, right? Because DMart started at 70-75 P multiple. That wasn't something that we're going to chase. So we want growth. See, at the start of the trend, growth is always cheap. It only at the end, with growth coming in, your valuations keep going higher. So a company that is growing at 30-40%, every quarter it keeps growing at 30-40%, your P ratio keeps going higher. And this works on the opposite side as well. And then you have your momentum investors who are looking for momentum, and then those guys get in. So if you find growth at a reasonable price, so we buy cheap. Cheap is a very difficult word. A consumer company is cheap at 25p. A steel company is expensive at 10p. So cheap is very different for every sector for us, but we buy it at reasonable valuation.
And how are you booking out your profits? So how are you locking in the gains?
So once we think, see, trends don't correct more than 20%. I'll just give you an example. Page Industry or Bajaj Finance, some of our holdings, our prior holding. Page Industry never corrected. From 350 it went to 17,000-18,000. It didn't even correct once more than 20%. So trends per se will never. So Dow Jones between 1992 and 1999, the Dow Jones went from 2,000 to 9,000. The Dow Jones never corrected more than 9% because trends are super strong, and you will come to know where the trends are changing. The headwinds will go away. The executions will lagger, and 1-2 quarters of bad growth, and I'm out of the company. See, you don't love your stocks. If we love the market, stock market is wife. Individual stock is a girlfriend. So we don't love anything, and don't love something that doesn't love you back. Your stocks don't love you. So we have no love with our stocks. We are there till the time our patterns are there, our trends are there, we can see growth, we can see value mitigation, we can see market share gains. We are with the stock. And we don't...
do you use technicals anywhere because you have a trader background?
I would say 10% I do use for my buying and my risk management. I do use it, but not so much. Like I will not see like a head and shoulder hai to bech do or flag hai to le lo. I'm not that shocked because my horizon is 75% of my holdings we keep it more than a year. So like that's our core portfolio. So we hold them for 1-2 years. So that we are looking at long-term trends. So in a long-term trend, there will be times when the stock comes down 15%, like they're coming down now. But that's okay, like till the time there is growth, we're not worried.
So in recent times, any stock with, okay, so you have, globally 20% and higher corrections are bear markets. You're also following that. So anywhere you have seen a stock which has corrected more than 20%, you have sold out, and then the stock has jumped back in and got back on the train. What do you do with that?
I don't get it back. So I'm emotional. You can call it very emotional and stupid. So that happened with TVS Motors. 2 bad quarters and we were out. The stock's gone more than 1x after that. We got Avanti feeds at 200. It went to 1600. We sold out after making 6-7 times. The stock has gone up. This is about 2014. The stock has gone up 30-40 times more after we got out. So we have made like a lot of mistakes, and we sold out Bajaj Finance too early, and we still not be able to get it. It's a class 30-40% growing company. So I've never been able to do that. We did it with DHFL, right? Actually, so DHFL we sold out 1-2 times and we got it back again cheaper. And yeah, with DHFL we got it right, but it's very emotional because I'm still, there are some psychological problems that we as investors face. And yeah, I've not been able to do that.
And okay, so when you've spoken about the psychological part, so how do you steal your mind? How do you keep the conviction? Because there are 2 things. One is being invested and having the conviction to ride the trends. So what drives your conviction?
So I am a guy who's always either I'm bullish or I'm not. If I'm not, I'm out. So I don't even think of catching the top, because I know tops we will never be able to catch. We're not even looking to catch the bottoms when we are buying. We are somewhere in the middle of the growth journey. Businesses go through startup, scale up, and mature stage, and then decline. If I'm convinced that the growth is coming and we are still on the scale up stage, I am there in the stock. Growth and P multiple will top out at the same time, right? The growth rate and the P multiple always top out at the same time. So we have to be cognizant of where the growth, if everyone knows that growth and everyone starts predicting that growth, we start cutting down our positions. So, but on coming to your conviction point, till the time there is growth there in this stock. See, I'll give you an example. Infosys, when did Infosys stop like coming down? When the growth rate changed from 100% to 30%. The day the growth rate changed from 100% in 2000, it was growing at 100%, 90 to 100% every year. 2001. First 1-2 quarters it grew at 30%, and that was also part of a global meltdown in Nasdaq and everything. So it was all global. It was nothing Indian about it. So once you get 1-2 bad quarters of growth, you have to exit a trend, because there is a lot of risks also in trends, and you have to sell it right. A trend will not 99% correct more than 20%. So once the 20% level from the top has crossed, we start getting a little nervous. And then we think that, are we wrong in the story? Is there something which is there? But then if we see that there are enough reasons that the growth will continue and markets are, this is just a short-term thing, then we stay long. But yes, but our stock normally don't stay down 20%. Or if they do, we get out.
So Amit, you have a very, very impressive self-styled methodology to investing. And if our viewers want to learn from you how to go about it, so tell our viewers what are the books to read, what are the resources to follow, and how you've taken and what have been your learnings from these resources.
Thing number one, investing is not for 8 hours a day. If you're not going to put in 16 hours, don't even try putting in 8 hours, because that's useless. For the last 100 years in the stock market, only 5% people take money of the 95% people. This is going to happen again and again, and for the next 100 years. Here again, you have to be in the 5% side. Here, knowledge is the only form of future currency. First thing is hard work. If you're willing to put in 15-16 hours a day, go for it. The second thing is books. Okay, I learned from the best investors, and I still read about what a Carl Icahn is doing or what a Bill Ackman is doing. I still learn a lot about them. So, but books, coming to books, I learned how to pick a stock from Peter Lynch. I learned how to value a stock from Warren Buffett. I learned how to hold a stock from Jesse Livermore. So, trends from Jesse, valuation from Warren, and stock picking from Peter Lynch. So that's broadly where my learnings come from. I still read, let's say, in 1 week a book, and but broadly those are my main learnings.
So you're reading a book even after being a very astute investor. You're still reading a book every week.
See, the thing is, you're always scared that you don't fall in the 95% basket. So for me and for the Stallion family, it's very important that I know what is happening. There are new changes happening, and with changes you need to understand how the market structure will look like. So macroeconomy is changing, politics is changing, so we read a lot even today, yes.
Interesting. So folks, if you have any more questions, you can always write in the comments below. And Amit is a very dear friend. He's always there to guide you, and we will have him on one more show. But before that, I would really like to thank you, Amit.
Thank you so much
for being there.
Thank you so much for coming this time.
So, friends, if you want to learn to pick multibaggers in a stallion kind of way, okay, you want to ride the stallion, then Amit Jeswani is your go-to guy.